I mean, first off, it's great to have a mind like you to be able to spew this knowledge about the international and U.S. markets, and huge benefit for me as a financial advisor. You mentioned 2008, so you've been through 2008, and right now is still some steady growth. Is there any concern? I know you had mentioned something as this being comparable, you said not as much to a 2008 of when it happens, and there still will be some time, everything looks strong, but talk to me about that. How would, over your career, and especially with that year, how does this compare as to what we're looking at?
So I mentioned to you earlier about imbalances that form, and it just so happened that the imbalances that had formed leading up to 2008 were of much greater magnitude than what we saw in sort of the prior slowdowns. And when I say prior slowdowns, I'm talking about the 2000, 2002 recession, and a lot of that was driven because the technology spending around the internet, around Y2K, and the fiber optic build out had kind of gotten ahead of itself. And the capital markets corrected for that. But what we experienced was more of a garden variety recession, because the global financial system, although there was a lot of investment bank underwriting that had benefited from that sort of investment boom around the internet, it wasn't enough to bring down the economy. It's like Main Street wasn't as directly impacted because Silicon Valley slowed down. You contrast that with 2008, where the imbalances were literally Main Street. I mean, it was a nationwide real estate lending frenzy that we saw, that most of not just the U.S. banking system and the U.S. And specialty financial services like mortgage lenders countrywide and IndyMac and others, but globally you had German banks and UK banks betting on U.S. housing, and it was a frenzy that when it corrected, not only affected Main Street because the slowdown in real estate or crash in real estate prices, but it brought down Fannie and Freddie that are still operating under conservatorship with the U.S. government. It brought down a lot of U.S. banks and a lot of German banks. And 2000, because of the magnitude and how widespread it was and what impact it had on the capital markets when it corrected, it left a scar. What I like to say about 2008 is it was the big giant earthquake. You have I coming from California, having experienced earthquakes, what usually happens is you have a big earthquake, and being a Californian, I kind of shake it off, But what I end up doing is I just kind of sit there and I say, okay, well, when's the aftershock going to come? Because we know that following a big earthquake, you're going to have a nice little aftershock that comes afterwards, and kind of remind you of.
We don't get those in Florida. We have hurricanes.
So you don't have aftershock hurricanes, fortunately.
No,
the eye comes through, and that's it. So.
Yeah. Well, we got the tailwind, so okay.
But so if 2008 was the big earthquake. 2012 was an aftershock. China slowdown in 2015, another aftershock. So we have these aftershocks because we're still feeling the effects of what happened in 2008, despite having experienced a nice bull market. And maybe one can credit global central bank response to what happened in 2008 by adopting emergency monetary measures, zero interest rates or negative interest rates in the case of Europe and Japan, expanding their central bank balance sheets to provide excess liquidity and reserves into the banking system to kind of try and stem off a major deflationary type of contraction like what we saw in the 1930s depression. But we're still feeling the effects of 2008. And what I mean by that is that we're going to, in this period, sort of post-2008 period, the growth is going to feel different, or it has felt different. It's going to feel like what Bill Gross and Mohamed El-Arian, formerly of PIMCO, had termed the new normal. And the new normal, I think, is in response to what happened in 2008 because of the excess leverage that hadn't been built in the system that was felt worldwide. But we also combine that with aging demographics worldwide, including emerging markets, where the worker to retiree ratio is plummeting. And you have the sort of excess debt levels that have been built up worldwide. and excess global manufacturing capacity that had been built up in the 2000s, that's going to have sort of ongoing deflationary effects. That's going to weigh down nominal world growth, but also keep inflation down as well. And it's just kind of a new environment that I think we have to get used to. Now, can we have, cyclical, big acceleration in cyclical growth, like kind of what we saw in 2017 and part of 18? Sure. But it's sort of all within the context of a new normal environment. What do you pay for risk in that kind of environment that looks different than what you were used to pre-2008? Well, that's the big debate right now. What spread do you demand above, say, risk-free treasury, or how much are you willing to pay for equity investments if the growth profile isn't as attractive? The reason why the U.S. has done so well versus the rest of the world is because in this sort of new low growth environment, the companies that operate more profitably with the best operating margins, the most efficient use of capital are the ones that are going to thrive. And that's what we've seen in the U.S. versus the rest of the world. We do still believe in the global investment story because at the end of the day, the U.S. is just one market. It might be 50% of the world market, but it's just one market. And we really believe in the concept of diversification, and that in any given year, you do not know what area of the market's going to perform better or worse versus another area. We always like to show the quilt graph of capital market returns where, if you picture a quilt and each square is a different color, it represents what asset classes were at the top and what were at the bottom. It's a quilt because there's no pattern. Just because something performed really well in one calendar year doesn't necessarily mean it's going to do well. Sometimes you see that,
diversification,
but generally you're going to see the quilt pattern, and that's why we believe in global investing and diversification.